Assalamualaikum and welcome to lecture 12. This lecture is very special. Why? How is it different from the previous 11 lecture? Because this is introducing to a new type of tax, which is capital gain tax. Unlike the previous 11 lecture where we were focusing on income tax, where individuals are taxed on their various types of income. Now we are moving one step ahead. We are moving on to capital gain tax when an individual is selling a capital asset and when they are incurring a gain on it. So that gain is chargeable not to income tax but capital gain tax. Capital gain tax is divided into 4 lectures. Okay, this will be discussed in 4 lectures. Lecture 12, lecture 13, lecture 14 and lecture 15. So this 4 lecture 12 to 15 will be focusing on capital gain tax with various issues. So the issues are divided in 4 parts. This lecture is an introduction to your capital gain tax. Remember, capital gain tax for individuals. Again, capital gain tax is divided into 2. One we have for companies also. Companies also can incur CGT. But here we are focusing on gains for individuals. So in this lecture, as you can see the topic basic principle, we are going to cover the basic principles, the pro forma, how do you calculate, the raise, the deadline for claiming, things like that. Okay, so let us start. The terminology, very important, you have to understand the terminology. Then chargeable disposal. What is this chargeable disposal? Then chargeable asset, chargeable person. These 3 things. Then computation, the pro forma. When you're disposing, what is the cost? Then what do you do with the enhancement expenditure? Then how do you calculate the tax payable? The loss relief. Then residential property when you're disposing. The married couples. Basic CGT planning. So CGT means capital gain tax. Whenever I say CGT, it is capital gain tax only I'm referring to. So this computation is for corporate taxpayers. See, this computation was for personal. Now corporate. Chargeable gain for companies. Of course, companies companies itself is a big lecture. Companies pay corporation tax. So when we go through companies, there we are going to study in detail. But here just one line. Okay. How CGT is calculated for companies will be covered in this lecture. And then we are going to cover how much of the syllabus we have covered, summarize the entire lecture, and technical articles. What are the technical articles available for you on this lecture? Now, so the terminology and personal taxpayers. Now, capital gain tax. So here, remember, if there is a loss, you don't have to pay any tax, like income tax. But if there is a gain, see how I'm referring to gain here. When it's income tax, I would be referring to income, taxable income. Here, taxable income is replaced to chargeable gain. Do you see the terminology? Only the terminology changed. When the tax changed, terminology changed. For income tax, it was taxable income. For income tax. For capital gain tax, it is chargeable gain. Looking at the word gain. And income tax had income. Now you understand. So chargeable gains. It's not chargeable income or anything. It's not income. It's gains. You can have loss also. If you're having a loss, you don't pay any CGT. Simple. So it arises when a chargeable disposal of a chargeable asset is made by a chargeable person. Chargeable person means the one who is taxed to CGT. Chargeable asset means those assets which you have to pay capital gain tax. That means they are taxable. They are not exempt from CGT. And chargeable disposal. Not all disposals are chargeable. Some are exempt from tax. So that's why we have to know chargeable disposal, chargeable asset and chargeable person. And if the chargeable gain, see if this chargeable gain is made by the personal taxpayer, capital gain tax. They will pay capital gain tax. But if the chargeable gain are made by companies, they are liable to corporation tax. You just add the chargeable gain with your income. Add all. When we go to company, you will understand this better. Okay. We are still under individual. We are still under personal taxpayers. We didn't go to corporate taxpayers. Okay. Now, so chargeable disposal. It includes the sale or gift. See, it could be sale also. It could be gift also. Anything. Sale or gift of all are part of a chargeable asset. Either you are gifting or selling all, or just a part of a chargeable asset. So these are chargeable disposal. They are charged to capital gain tax. Loss or destruction of non-vesting asset. What is non-vesting asset? Non-vesting asset means vesting assets have an expected life of 50 years or less. Non-vesting asset. Asset which have more than 50 years. If vesting asset is having expected life of 50 years or less, non-vesting asset is having more than 50 years. So if this is destroyed or it's lost, that is also a charge. That is also taken as a chargeable disposal. You might not gift or sell, but if it's losing, if it's just there's a destruction, okay, then when you are receiving a capital sum, for example, you are receiving anything from insurance, the compensation that you are receiving from insurance for your loss is a chargeable disposal or a destruction or a damage of a non-vesting asset. Now, so this three. Then the date of disposal is very important. Generally, when the asset is sold or transferred, or it could be a date the contract is signed where the asset transfer requires a contract. That means to transfer an asset, a contract is required. So we'll see the date the contract is signed, or if there is any condition attached to the contract, then when the condition is satisfied, that is the date of the disposal. So you have to look for all this. When the loss or the destruction occurs, when the capital sum is received. Okay. So that would be your date of disposal. Now, some disposals are exempt disposal. They are not chargeable. How? From income tax, we have some exemption. From chargeable asset also, disposal also, we have some exemption. If we are making a gain also on this exempt disposal, it will not be chargeable to tax. Because the gain is not chargeable, any loss if you are incurring will also not be eligible for tax relief. See, for losses, we get tax relief, no? We carry forward, utilize in the current year, we have seen in the previous lecture. Loss relief for sole traders, same. Because the gain is exempt, the loss is not eligible for tax relief. That is the disadvantage of exempt disposal. Next, so the transferee, the one to whom it is transferred are known as transferee. The one who is transferring is known as transferor. So the transferee acquires the asset at its market value on the date of disposal. Okay, at the date of disposal is the market value. Main examples: disposal of any chargeable asset held at the date of the transferor's death, disposal of an asset designated as an exempt asset. This will cover in section 1.3. Then some disposals, they will be treated as no gain no loss disposal. In this case, your sale proceed will be equal to the cost. So you are not incurring any gain also, you are not incurring any loss also. So what happened? In this case, it is said that the transfer is acquiring the asset at the cost to the transferor. Whatever is the cost to the transfer, at that cost only transfer is acquiring. It is taken. So these are the main examples. Between husband and wife, any disposal between husband and wife, no gain, no loss. Okay. So whenever you are having husband and wife example, no gain, no loss. Don't calculate gain. If gain is calculated, it's wrong. You have to correct it. So when anything is disposed, okay, I'm talking about chargeable asset. Exempt asset, anyway, they are not taxed. So when a chargeable asset is disposed between the husband and wife, it is at no gain, no loss. Then, exchange of shares following a capital reorganization of the company. When the shares are exchanged, you want to take over. Okay, when you want to acquire another company, you might be giving up some of your shares to acquire the shares of the target company. In that case also, that is at no gain, no loss. This, by the way, we'll cover in the upcoming lectures. One part is dedicated to just shares. Okay. Then, when you're taking over one company by another company. So in this three case, no gain, no loss. Remember the situations always. Okay. Next, we are moving on asset which are exempt from CGT. Now we are moving to chargeable asset. So the taxpayer's private residence is exempt in most circumstances. Okay, we'll cover this in lecture 13, the next lecture. Not all the residents, only the private residence where the taxpayer is actually staying. Why? Because there's a relief known as private residence relief, PRR. That's why. Then, if you're having any qualifying corporate bonds, such as loan stocks issued by a company, exempt from CGT. By the way, this also we will be covering in the later lectures. Then government securities, marketable gilts, non-marketable, premium bonds, exempt from CGT. Then vesting chattels. Vesting chattels are those assets with life not exceeding 50 years. But remember, vesting chattels, unless they are plant and machinery qualifying for capital allowances. If they are plant and machinery qualifying for capital allowances, it is not exempt from CGT. Otherwise, vesting chattels are exempt. So this 4. Now, we have some more to this list. Non-vesting chattels. Non-vesting chattels with current market value and cost, both the market value and cost not exceeding 6,000. Okay. So here, antiques, work of art, if the cost in the market value is less than 6,000, it is exempt from CGT. And also low value items of movable business plant and machinery exempt from CGT. Then cars, including vintage and veteran car, exempt from CGT. Foreign currency acquired by an individual for the purpose of meeting personal expenditure outside UK, exempt. Decorations awarded for valor unless acquired by purchase, exempt. Investments held in ISA, exempt. This we have covered in lecture 3 when we were going through investment income. So there we told it is exempt from income tax also, it is exempt from CGT also. Now you can go back and check. Now you'll understand this better. Now, then what are the classes of chargeable asset? Land and buildings, shares of companies. Remember, land and buildings, shares, goodwill, all these are your capital assets. Income tax is not charged on this. When you're selling this type of assets, land and buildings, when you're selling your share, when you're selling a goodwill, they are your chargeable asset. You pay capital gain tax on them. And high value, non-business, non-vesting chattels like jewelry, work of art. And in this case, both current value and cost is more than 6,000. See, they will give you where both are more than 6,000 or both cost and value less than 6,000. They will not give you where one is less than, let's say the market value is more than 6,000 but the cost is less than 6,000. They will not give you that situation. It was there before in the syllabus, but now it has been uplifted. Things have been easier for you. Now, high value business plant and machinery, but only if it is sold at a gain. That means you are selling it more than the original cost. Then it's chargeable. Vesting assets other than chattels, like copyrights. See, copyright, if you are selling, it's a chargeable asset because copyright has a life, useful life to it. Then, what about when you're selling a loss? When you're selling a plant and machinery at a loss, what happens? You can get the loss relief. How? Through capital allowance. Okay. Because tax relief was given through capital allowances, the capital loss cannot be established as the cost has already been attracted tax relief through capital allowance. So when you are calculating capital allowance, that time you already got the benefit. The tax relief you got from there. So you're not going to have some additional tax relief for the loss. That's the only thing I wanted to explain here. Now, chargeable person. Chargeable persons are all individuals and companies. Now, part 2. So we have moved on to computation. Here we discussed all the terminologies done. Moving on to pro forma. Here, first we start with the sale consideration. This will cover in section 2.2 in detail. What sale consideration is made of. Then we deduct the cost of sale. This will cover in section 2.3. Then net consideration. From here we deduct allowable expenditure. Okay, so your acquisition cost, what was the cost of acquiring it, plus the incidental cost of purchase. Any enhancement expenditure, enhancement will cover in section 2.4 to enhance this thing, that will be added with your cost of purchase. Then whatever the expenditure you have incurred to establish, preserve or defend the title to the asset will be added. And then finally from your net consideration you deduct this 3 allowable expenditure and get your chargeable gain or allowable loss. Now disposal process. So here disposal process will be your gross sale price. They will give you the proceed, don't worry. And your gross selling price becomes the cost for the future disposal. When you are disposing it in the future, sale proceed today becomes the cost that time. Okay, it becomes the cost for the purchaser. Your price, selling price will be the cost for the purchaser, the one who is purchasing from you. Then incidental cost of disposal, valuation fees, any valuation fees you have to deduct to dispose that. Then advertising costs, legal costs, selling costs, for example auctioneer's fee, brokerage, agent's fee. To dispose that asset you are incurring all this selling costs. It is incidental on that disposal only, otherwise you would have not incurred this cost. This you can deduct. Okay, this 4 cost. Next, remember anything out of this 4 list given you don't deduct. Enhancement expenditure, so they are your capital cost of improving the asset. So this, let's say you are extending a building. Add it. Now the rates of CGT. So the CGT are calculated on the taxable amount of gain, and like income tax we take the tax years ending 5th April. So how for income tax we take the tax year from 6th April to 5th April, same for CGT from 6th April to 5th April. Any gain you have incurred in this time tax year you have to pay CGT. Same rule applies. That's why you have to study my income tax first before you come to CGT, by the way. Now unlike income tax where it is slab based on income, first 37,700 20%, and for dividend and then 40 45 basic rate, higher rate, additional rate. When you come to CGT there are 2 rates, and these 2 rates also depending on whether it's a commercial property or a residential property. So even here it is depending on the taxable income, taxpayers taxable income. See how we have to link back to income tax. We need the support of income tax for CGT. You need your taxable income. Based on that we'll see at what rate you are. Okay, then so when you are disposing a residential property, either it would be 18, either it would be 24. And when you're disposing other chargeable asset, that means other than residential property, then the rates are lower than residential, 10 and 20%. Again this is depending on the taxable income. So the lower rate is 10%, upper rate is 20%. When it's a residential property, lower rate is 18 and higher is 24. In your exam they will always specify whether it's a residential property or not. And when you're disposing, if a disposal qualifies for a business asset disposal relief, that means that asset is a business asset. So you might get a relief known as BADR, business asset disposal relief or investors relief. This reliefs will cover in lecture 15, the last lecture I told you under capital gain tax. The last lecture will consider all the reliefs available for CGT. There are so many reliefs, in fact. So this two reliefs means what happens? What is this two relief? When you're disposing this two relief means this rate is always 10%. So your CGT you should pay at a lower rate 10%. That is the relief you are getting. You are paying at a lower rate, always 10%. You're not rising to 20%. But anything excess beyond this, for example, if your gain is more than the relief, you're not able to cover everything through the relief. There's a limit for the relief also, okay? By the way, there's a limit. So beyond that, then the excess will be charged at the higher rate. Okay. Now, calculation of tax payable. So this first your current year gain, deduct your current year loss is known as net chargeable gain. Then deduct annual exempt amount. How we deduct personal allowance from our net income? Here from net gain, we deduct annual exempt amount. For this year, it is 3,000. It's fixed. Like how personal allowance 12,570 for income tax is fixed. So here it's annual exempt amount. Most of the students forget to deduct this and they start calculating tax on net chargeable gain. Don't do that. Then if you have any losses, if you don't have, directly you can calculate tax. But if you have any losses brought forward, mostly they give you losses brought forward in your question, okay? Because they want to test. Then you have your taxable amount. On this you have to pay tax. Then, so the amount is AEA is 3,000. Up to 3,000 of gain, no CGT. Now, so this AE is equivalent to personal allowance. But remember, there is an advantage for CGT. That is, this AEA 3,000 is not reduced. It's not reduced like your personal allowance, where your adjusted net income, if it is more than 100,000, personal allowance reduces, right? Your AEA doesn't reduce. It's always 3,000. Okay. So your net gain could be any amount. Annual exempt amount is always 3,000. And this amount is given in your tax rates and allowance provided in your exam, in case you forgot. Now, so for the purpose of deciding which rate of CGT, remember your gain, the taxable amount of gain is added to the taxable income. First taxable income, then gain. Okay. Remember, it has to be in the same tax year. It is taken as if the gains were the tax-based income only. However, when you are calculating, the income tax and CGT computations has to be separate because the rates are separate. But you will be adding them together. Now, if your taxable gain falls within the basic rate for income tax, see, when you're looking the basic rate, you look at the income tax level, okay? There is no threshold given for CGT. The income tax basic rate 37,700 only you have to take. So if gain falls within 37,700, your rate of CGT is 10%. Or 18% if it's a residential property, the lower rate. And anything beyond the basic rate, it will be at higher rate, either 20% for commercial or 24% for residential. But remember that 37,700 basic rate, if there are some personal pension contribution or gifted payment done, your your 37,700 will be extended. That extended amount you have to take, if it's extended, to decide the rate of CGT. And as I told you, if your gain exceeds the basic rate band, CGT is 20 or 24. And what about additional rate income? See, additional rate or higher rate, they will still pay 20 or 24. So both higher and additional will pay 20 or 24, the higher rate. Only the basic rate will pay the lower rate. How can it happen? See, sometimes your income might not exit so much. You might still remain in the basic rate. So some portion of your income. That means, so you can take it from gain. That means some portion of your gain might be taxed at the lower rate. The balance, the excess might be charged at the higher rate. Sometimes your whole gain will be covered by the basic rate. So that means the whole gain will be taken at the lower rate. So we'll see your question to help you to understand this better. That is activity 1. In first one, you are supposed to calculate taxable gain. And then calculate CGT payable. See, this is taxable gain, not CGT yet. CGT payable, that means your tax you have to pay, calculate in part B. Assuming the taxable income, they have given you the taxable income already. Assuming is 50,000, first one, then 20,000, then 30,000, then 140,000. And here he does not make any gifted donations. Does not make any gifted donations. But in the third and the fourth, pays contribution of 12,000 gross, pays contribution of 30,000 gross. Why did they give you? To extend your basic rate band. And here they are selling the chargeable asset for 64,900 before the selling cost 400. Selling cost is 400. He acquired the asset for 10,000. Capital expenditure 3,000 and 2,000. The asset was not residential property. So what rate will apply? 10 or 20%. Simple. Now let us do this. So let us calculate the taxable gain. To calculate the taxable gain, we need the sale proceed. So sale proceed is 64,900. Now you will be deducting your cost, selling cost. $400 minus 400. So now let us do the sum function and find the net sale proceed. This is your net sale proceed. Now deducting the cost. So 64,500 keep here and the cost. So under the cost we have original enhancement. Remember enhancement we did twice in two different tax years. So what is the cost? The cost was 10,000. And then first time we had incurred 3,000 expenditure and then 2,000. So now just take the sum function of this 3. And here also we have to use the sum function to find the gain. This is the total of the cost. So 48,500 is your chargeable gain. Do you pay tax on this? No. What about annual exempt amount? So we deduct our AEA, annual exempt amount, 3,000. Do not forget to deduct that. Now, once you keep on doing CGT, you will get the hang of AEA. You will get the practice. Wait, there has been a mistake somewhere. This is 2,000. So automatically everything changes. Now, this is 46,500. So your taxable amount that you are asked in the requirement to calculate is, you have finished the requirement, 46,500. Now, part B. Assuming taxable income is 50,000. So if you see the 50,000, it is a higher rate. Okay, this is non-residential. So now, this will be paid at the higher rate, which is 20% of CGT. Okay, so this multiply by this, 9,300. Now, if your taxable amount, part B, is 20,000. Okay, so it's less. Remember, when it is 20,000, okay, so from 37,700, take 20,000 out. Let's put an equal 17,700. So out of this gain, which is 46,500, 17,700 you can charge at a lower rate. Okay. So this 17,700 would be taxed at 10%. The balance, that is this minus this, will be charged at the higher rate. Now, and the sum of the two. So part B, this is the answer. This is your CGT payable 7530. Now moving on to part C. It's 30,000, but you're paying contribution 12,000. Remember, already they have given you gross up, so you no need to gross it up. Just add 12,000 with your basic rate band. So I've done some plus 20,000 plus 12,000. Sorry. So now the basic rate is 49,700. Okay. And your taxable income is 30,000. Okay. So from this is your basic rate band 30. 19,700. Okay, up to 19,700 will be taxed at 10%. And the balance, that is this minus this, will be charged at 20%. Remember, this 49,700 is your new basic rate band. This one was 19,700. So now I'll be adding the total just to find the limit. Just to find this 19,700, we found the basic rate band, and then this will be the taxable amount minus the new basic rate band left. So 7330. Next 140 and 30,000. So the last part with 37,700, we will keep it separate. Add 30,000. So your new basic is 67,700. Then your taxable income is 140. That means you have utilized the basic rate entirely. So what's there? Everything will be taxed at the higher rate. This entire will be taxed at 20%. Hence, your tax is 9,300. So this is the answer for activity 1, where we have got the taxable amount 46,500. Using this, we have calculated B when the taxable income was 50. So it was more than the basic. So we applied the higher percent, 20% with 46,500. This 46,500 you don't have to calculate again. It's calculated in part A. Then second one with 20,000, because it is basic, so we still have some left. 17,700 is taxed at the lower rate. If you take from 37,700, that is the basic they have shown here, and the balance is taken at 20%. In the third, we have some contribution of 12,000 gross made. It is added to the basic rate and it is extended. So then we found the tax. And then for the fourth one, in the same way. Now, Allocation of unused basic rate band. So when we are allocating, okay, it is important that this unused basic band is allocated first against non-residential property gain. Why? Because if you see the difference, it's 10 and 20. The difference between them is 10%. You can save 10% of tax. Whereas if you take residential, it's 18 and 24. The difference is only 6%. It's less. So if you're setting it against non-residential property, you are going to save more tax. So it's non-residential property first, then residential. Now, where a taxpayer has chargeable gain that has both residential and other asset, even the annual exempt amount. Okay, it is beneficial to apply the annual exempt amount to the more highly taxed residential property gain, because residential property are taxed at a higher rate. You see 24 and 18. 24 is the highest. Better to set off the annual exempt amount against residential property. We'll see example 2 for this. So this is example 1. Okay. Here, Andrew has a salary of 25,000. Taxable income is 8,000. And residential property gain 21. And other gain is 15. So what should you do? We'll see how much of the basic band is remaining. Ignore the AEA for now. So basic rate is 37,700. Right? Our salary was 25. Add investment. Do not take the chargeable gain of other assets and residential. Only investment and salary. And deduct your personal allowance. Because we want to find what is the basic rate band remaining, right? So the taxable income, do not forget to deduct the personal allowance because you have been given the income. Okay, you have to deduct and find the taxable income. So if you find the difference, this much of the basic rate band is still remaining. That means this much of your gain could be taxed at the lower rate. So first you will charge against your residential property. Yes. So 17,270, this will be charged at 18%. The balance of your residential property. What is your residential gain? 21,000. So out of 21, 17,270 is at basic and 3,730 higher rate, that is 24. Now coming to the other asset. Okay, other asset is 15,000. So nothing is left in the basic, straight away 20% the higher rate. And add. What happened? This is your total tax. Now we are applying the unused basic rate band to the other gain first and saying what is the impact. So other gain is 15,000 and you are having 17,270. So the entire thing will be taxed at 10%. Still there is some portion left, 227. This will tax the residential property, that is 18%. And the balance 2270, right? Residential is 21,000. So from 21, 2270 is taxed at the basic 18. The balance is at higher rate. When you add, this is the total. You see you are saving more tax. Tax is lower when it is used against the other gain first. When the basic rate band is utilized against other gain first. Why? Difference 10 and 20 is 10%. Whereas residential, it is only 6% difference between the higher and the lower. Now, loss relief for the personal taxpayer. So there's a current year loss. So for the personal taxpayer, your current year losses must be set off against the current year gains. Even if that brings your net gain below your annual exempt amount, that means below 3,000. So what happens when your net gain is less than 3,000? Some of your annual exempt amount or all of your annual exempt amount might be wasted. Same like personal allowance. And unused annual exempt amount you cannot carry forward. That is a disadvantage. And if the current year losses exceeds your gain, that means you're having a net loss, then that unrelieved loss you cannot carry forward and set off against your trading income. But unrelieved loss you can carry forward and set off only against your capital gain, not trading income. This is the only difference with my previous lecture, where you carry forward and set off against the future trading profit. Here it is capital gain, capital loss with capital gain. And remember, when can you set off? After deducting annual exempt amount. Capital gain after deducting annual exempt amount. Then, where a taxpayer has a chargeable gain of both residential and other, how do you apply the losses against what property first? More highly taxed residential property gain first. That means at 24%. Take your loss against the residential property first. So, example 2 will help you to understand this better. First, as an example 1, except now he has a capital loss of 2000. Okay. So, the basic idea, offset your AEA and loss against residential property. Rule number 1. Rule number 2, unused basic rate band against other gain. If you remember this rule and you stick to it, you will never get wrong. You only have to memorize this line. AEA and losses against residential, unused basic rate band against other gain. So now you will always take other gain and residential property separately in 2 columns like this. It's always like this. Do not mix the two. Do not add them together because the tax rates are different. Okay. So from our example 1, your other gain was 15,000 and residential was 21,000. Remember to deduct capital loss. So this capital loss, first we'll deduct capital loss before we deduct AEA. Your annual exempt amount is always deducted the last after you deduct the loss. So 2000 from residential property. You see here, and then we are deducting the 3000. Then we got. So now we will be taxing based on other gains first. Okay, you will be utilizing the unused basic rate band against other gains. So when you go through example 1, okay, we have some amounts left unused basic rate band. Looking at the taxable income. So now in this first one, okay, see here we will be utilizing it against residential property. You see, so this 15,000 unused band first against other gains. So that's why 15,000 into 10%. And still, see, this much of your basic rate band is remaining. Out of this, 15,000 is taxed at 10. The balance at residential. That's why the lower rate of 18%. And then the balance. Because if you add 15,000 and 16,000, your total is 31,000. Okay. So the balance will be taxed at the higher rate of residential, that is 24%. Add them together. This is your CGT. Now, in the second one, we are going the other way around. Just remember, it is 5204. Okay. This time we are changing. Reverse. AEA and losses will be offset against other gain, and your basic rate band will be utilized against other gain as well. So residential property you don't have to touch. It remains 21,000. So 2,000 and 3,000 you deduct, and now taxable gain is 10,000. So this will be taxed at 10%. And then the balance is at 18%, the lower rate of residential for the basic. And the next, once you see up to this much, basic rate band is unutilized. After that, beyond that, it will be at a higher rate. So higher rate of residential property rate, 24%. When you add, this is 5604. You see the difference? So the first one was ideals because you are saving more tax. Taxable gain is same under both 10,000 and 10,000. I'm sorry, not 10,000, the total 31,000. There it was 15 and 16, here it's 10 and 21. Taxable gain, the total taxable gain is 31,000, but the CGT is less in this case. Okay, it is lower by 400. So the ideal situation is the first one. Set of AEA and loss against residential property gain and basic rate band against other gain. Now, loss relief for brought forward losses. So current losses are over. If it's a brought forward loss, okay, remember your annual exempt amount will be deducted only after your current year capital loss. But before any brought forward losses. Current year loss, yes, but before brought forward loss. Why? Because the unrelieved brought forward losses, you can carry it forward. But annual exempt amount you can't do. So unrelieved brought forward losses are only set off as to reduce your net gains to nil. It can only reduce your net gains to nil. The remainder is carried forward. Now, activity 2. So here we have brought forward losses. Okay, that is brought forward loss round 22-23 of 11,000. And he has been making losses in both the tax years with gains, of course. Now you have to calculate the taxable amount for the two tax years after you deduct the capital losses. Assume the 2024-25 annual exempt amount applies in both the years. That means the 3,000. So now let us do activity 2, where you have to calculate taxable amount for multiple years. Do it simultaneously, okay? So here I'm going to do, get this, I shall remove this now. So we'll do for 2024, 2023-24, 2024-25. First is the gains. So here 8 and 20, 8,000, 20,000. Then we have the current year loss. Current year losses are 500 and 8,000 minus 5,500 minus 8,000. Done. Then net gains in year. It's a net gain because your losses are less than your gains. So we'll take the sum function here. Take it to the next cell. Now we'll deduct our annual exempt amount, AEA. Here you can't deduct the entire 3,000. Can you? Yes, you can. Because unlike your personal allowance, remember AEA is not restricted. It's always 3,000. And in this case, it is 3,000. So now when you do the sum function, remember this will be 0. Even though when you take 2,500 minus 3,000, it will show negative, but you have to write 0. And here, sum function. So 9,000. Now the losses brought forward you have to deal with. So when you are getting the losses brought forward relieved, you can't get anything relieved in 23-24 because nothing to get relieved, it's 0. But 24-25, yes, you have 9,000 to get your relieved. So here, what is your brought forward loss? 11,000. So from this 11,000, we are taking the entire 9,000 will go. So unrelieved loss will be 2,000. So both this tax here, you don't have to pay anything because this 9,000 also will go by the brought forward losses. Because total loss is but 11,000. And the gain you are having is 9,000. So you are left with 2,000 unrelieved losses which you will carry forward and get it relieved in 25-26. Okay. So this is the answer for activity 2, brought forward losses. As you can see in 2023-24, you cannot get anything relieved because it's zero after annual exempt amount. Okay. Now, but in 24-25, we have 9,000 gain, and when you utilize your brought forward losses, you are left with nothing. So 2,000 will be carried forward. Now, residential property. So when you're disposing residential property, there normally you don't have any balancing on payment for CGT, capital gain tax. But for residential property, there will be a payment on account, and this payment on account is due within 60 days of the disposal. And annual exempt amount. So the annual exempt amount, any capital loss incurred in the same tax year before you dispose your residential property plus any capital losses brought forward. They are all taken into account when you are calculating payment on account. Once again, I repeat, the annual exempt amount, capital loss brought forward in the same year. Remember, before you dispose residential property plus any capital losses brought forward. Any chargeable gain, any other chargeable gain and capital loss incurred after the disposal of residential property are ignored. Okay. So before residential property, taken. After residential property, ignored. Now, the residential property disposal will still be included in the taxpayer self-assessment capital gain computation following the end of the tax year, with the payment on account being deducted from your total capital gain tax liability. So what happens? The payment on account will be deducted from your capital gain tax, CGT. And if there is any additional tax, so any additional tax is payable on 31st Jan following the tax year. Remember the balancing payment for income tax and class 4 NIC, 31st January following the tax year, same. That is the date. So any additional tax will be payable on that date. If you are going to get a repayment, this will be claimed when the self-assessment tax return for the year is submitted. Along with your tax return, you can claim the repayment. Now, there is no need to submit a return if there is no CGT. No CGT, then don't submit a return. For example, you are selling the property at a loss, or your gain, you are incurring a gain, but that gain is 3,000 or less than 3,000. That means it is covered by your annual exempt amount or your private residence relief. That means it's your main home where the taxpayer is living, the entire amount is exempt from CGT. So because it is exempt from CGT, then no need to submit a return to HMRC. But remember, this private residence relief we will cover under the relief section when we study the various relief. There are various relief for CGT. Okay. So private residence relief is one of that which we are going to study in detail. Now, exam advice. Whether the taxpayer is a basic rate taxpayer or higher rate taxpayer will be given to you in the exam. Why? So that you can determine the rate of CGT to use. And the calculations of payment on account when there is more than one residential property will not be asked. You will only be given one residential property. If so, otherwise they might not give anything at all. Then, unless you are told that the asset that you have disposed is a residential property, you should always assume that it's not residential. That means always apply 10-20%. If it is specifically residential, the question will state that. Now, example 3 will help you to understand the payment on account for residential property. Okay, so here Jyoti is a higher rate taxpayer. He has the following chargeable gain and losses. So this all falls in the, it follows a chronological order, 2024-25 only. There has been a brought forward capital loss. There has been a capital loss 5,000 from land. Then two chargeable gain. One from disposal of share. The other one is disposal of residential property and capital loss from a disposal of shares. So now let us sort this. So now the payment on account of CGT will be due by when? When did you make the disposal of residential property? 31st July 2024. Right? So 60 days from that day. From 31st July we are taking August, September. August there are 31 days and September, that's why we are taking 29th of September. So 29th of September, 29th of September is the date of your payment of account, because you have to calculate from 31st July 2024, because that is the date when you are disposing of residential property. So 60 days, always count exact 60 days, it's not 2 months, because sometimes some months might have 31 days. See, because it is July 31, after that we have August there are 31 days. So September we can't take the entire 30 days of September, otherwise 30 plus 31 will make up 61 days. So 29 September will be a payment on account for residential property. Okay, because residential. So now we will find the residential gain. What is the residential gain? You have 125,000. Then from this we deduct the current year loss 9,000. Can we deduct 9,000? No, 9,000 is the brought forward losses. We have to deduct the 5,000. I'm doing a mistake and I'm showing you the capital loss 5,000 from land, then annual exempt amount. This is AEA. Current year loss, and then I'm going to do the sum function. From here I'm going to now deduct the brought forward losses and do the sum function. This 9,000 is the brought forward loss. 108,000. Now this is residential property. Lower rate or the higher rate? Growth is a higher rate taxpayer. So you will pay residential property at 24%. CGT is at 24%. Yes. Your CGT is 25,920. Now you have made a loss. If you see 30th September, capital loss of 10,000 from disposal of shares. The last item. But see, this loss was after you have disposed of your residential property. Therefore, this is ignored. Okay. So now you have to calculate your CGT on 31st Jan 2026 as this. On 31st Jan 2026, your CGT would be again your residential property gain 125,000. From here we will be deducting the losses. So when we are deducting the losses, now we take the 10,000. So 5,000 loss from land, 10,000 from loss of shares. So 5 and 10, 15,000 loss. Rather than taking 15,000 like this, when you are doing show working, minus 5,000 plus 10,000. Minus 10,000. Okay, so it's minus 15,000. Now you deduct your annual exempt amount of 3,000. Remember, you need a sum function. You can't directly deduct your brought forward losses because you need to know the total. This could be sometimes less than your brought forward losses. Now it's 107. You can deduct your brought forward losses 9,000. And now do the sum function. Nothing is unready to be carried forward. Everything is utilized. 98,000. So out of this 98,000, okay. Now, what's next? You need the other gains of share. If you see, okay. Now, this 98,000 is there. This is when we took our residential property gain and deducted AEA and the capital losses and the brought forward losses. Because we are told to take it from a residential property gain. Then your other gain is 11,000. This is residential property. This is other. That 11,000 gain is from selling of shares, other gain. Now calculate CGD. When you are taking CGD, is a higher rate. So this 98,000 will be taken at the residential property 24%. This 11,000 will be taken at the 20%, the higher rate. Next, I have to put the equal sign. 25, 7, 20. This is when 31st Jan 2026. Here you have to deduct payment on account. This one. Remember 29 September, this payment on account you have to deduct from here. Minus 25, 920. So it's showing a loss 200. What is it? It's a tax repayment. So you are going to get a repayment of 200 tax because you have paid more tax in payment on account. You have paid 200 more than your actual amount of tax on 31st Jan 2026. So the answer for example 3, okay, is 200 of tax will be repaid. Now moving on to the married couples. They are treated as separate taxable person. This we know from income tax. Same for CGT. Now, so for each person a separate CGT computation must be prepared. With each spouse, they will be able to relieve their own losses against their own gains. And they are entitled to separate annual exempt amount. That means 3,000 each. Inter-spouse transfer. It's possible they can do an inter-spouse transfer. Okay. But there are some special rules if there's a inter-spouse transfer. Okay. Now, for inter-spouse. So normally what happens when we are making a sale or a gift, we do it at open market value, right? We charge a proceed. There is an amount that we charge, deduct the cost, and we get a gain or a loss. But when the transfer is among the spouse, okay, then the open market value rule does not apply. Instead, the transfer takes place at no gain, no loss. So actual proceed are ignored in this case. The proceed of the transferor will be the cost of the transferee. So you understand. That means whatever is the original cost of the asset, it is assumed the spouse is going to receive that gift at that cost. So this special rules only apply when the spouses are living together. If they are permanently separated, this no gain, no loss rule will not apply. Now, subsequent disposal by the transferee. Once an asset has been transferred to the spouse, now that spouse is later disposing it. Then what happens? Then it's a charitable disposal in the hands of the transferee spouse. Okay, so in that case, the transferee's cost will be the same as the cost to the transferor spouse. Okay, now activity 3. So through activity 3, we'll understand this now. So there is an asset 60,000 and he gave the asset to his wife with the market when the market value was 90,000. Sold the asset for 130,000. So what is the CGT payable by the wife? Assuming her taxable income is 40,000. That means it's a high rate taxpayer. 40,000 means what? There is no basic rate remaining. So now, first we'll find the gain. What is the sale proceed? 130. Deduct the cost 60, which is 70,000. So this 70,000, do not forget to deduct the annual exempt amount, which is 3,000. And then because it's a higher rate, so apply 20% other asset, not residential. 20%, so 13,400. Now, what happens? Remember, because this value, this transfer is among the spouse, that means that no gain, no loss. So the cost to the Holman's husband will be 60,000. The market value of 90,000 can be ignored in this case. Okay. Now, so how do you do the tax planning? Here, if your net gains, remember, are under 3,000, you pay at 0%. Otherwise, for other assets, 10 or 20%, residential property, 18 or 24%. So if you are a wealthy married couple, okay, so thus a wealthy married couple can dispose of their chargeable asset during their lifetime, should arrange the ownership of assets in such a way as to minimize the collective exposure to CGT. That means you have to keep the asset with the spouse, okay, in such a way that both together are paying lower tax, lower CGT, especially the chargeable asset. Okay, so when you're considering who has to own the chargeable asset, you have to make sure that both of you are maximizing the annual exempt amount, the basic rate band, and the capital losses of both the individuals. Three things: annual exempt amount, basic rate band, and capital losses. Now, so let's say you are dividing the family estate. This might not be the best split for CTD purpose. Okay. Let's say you are dividing it for the CGT purpose, but it may not be best split for the other purposes. Sometimes if you're trying to save on CGT cost, there might be some other cost. In some other areas, you might be suffering. Okay. Sometimes when you are having a disadvantage as CGT, you might be saving on your other areas. So let's say you are dividing a family estate for CGT purpose, but in terms of other area, how it can affect, it can minimize your income tax or your future inheritance tax, which is in a way it's good because you're saving on other taxes as well. Remember, you have to take the implications of all the types of taxes. This is only possible after you study all the different 5 types of taxes. They are income tax, capital gain tax, corporation tax, inheritance tax, and your VAT. These are exact 5 types of taxes that we are going to cover in ATX as well, but of course with more additional things. They are more detailed, more things added which are not covered in tax. Now, example 4. So this is about Katie who is married to Paul, and now Paul, so she has made the following chargeable gains. One from painting 30,000, the other one is from jewelry 20,000. And the only income of Katie is her employment income of 66. Paul has a taxable income of 13,000. Remember one thing, the moment you are given taxable income means no need to deduct personal allowance. It has been deducted. But if you are given employment income, you have to deduct your personal allowance. It is not your taxable income. Okay, so let us solve example 4. So now we will calculate when the assets are solely in the Katie's name. Then we'll calculate the chargeable liability, the CGD. So what is the total chargeable gain? If you see, add 30 and 20, it's 50,000. Okay. Total how we calculate total taxable income in CGT? We calculate total chargeable gain. 30 and 20 you add and it's 50,000. Then deduct 3,000. This is your annual exempt amount. And the sum function 47. So remember, looking at the employment income of Catty 66, he's a higher rate taxpayer. So this is other income. They would have mentioned if it was residential. So the higher rate is 20% for other assets. Now this into this. So your CGT is 9,400 if it was in the Catty's hand, which is a high rate taxpayer. But Paul is having a taxable income of 10,000. She's a basic rate taxpayer. Now Katie will transfer some assets to Paul so that CGT could be reduced. This is not the best option, optimal situation. Now, what should Katie transfer? The painting or the jewelry? Which would make a bigger impact? See, if you see the chargeable gain, okay, employment income is 66. Only employment income 66. Right, to reduce this 66 to a basic rate, what should she transfer? The jewelry or the painting? See, the jewelry is 20,000, but painting is 30. If you deduct from 66, if you deduct 20, it is 46. Still, Katie would be higher rate if she transfers jewelry. But if she transfers painting to Paul, painting is 30,000. So from 66 employment income, if you deduct 30, then it's 36,000. So then she becomes a basic rate taxpayer. Then Katie would become a basic rate taxpayer from high rate taxpayer if she transfers painting to Paul, which is worth 30,000. So now transfer painting to Paul. Now Katie, K and P. So Katie would be having a chargeable gain of 20,000 only the jewelry. The 30,000 is transferred to Paul. Okay. Then from this 20, deduct annual exempt amount minus 3,000. It's the same here. Then calculate the net chargeable gain. 17 and 27. So because is a higher rate, still 17,000. If you look at the employment is 66, she'd be paying at 20%. And here, see 27, she has a taxable income of 10,000, right? Basic rate is 37,700. Okay. So if you add this taxable income 10,000 with this 27,000, it is 37,000, still below basic rate. Basic rate is 37,700. So the entire amount, this 27,000, could be taxed at 10%. So here, this into 20%. And here is the sum function. Uh, Now what happened? You see, tax here is 9,400, here it's less. They are saving 3,300. So transferring the asset to Paul is advisable in this case. So this is the continuation example 4, where when the assets are solely in Cathy's hand, who is a high rate taxpayer, it's 9,400, and when the painting is transferred to Paul, 3,400 and 2,700. Together they are paying tax 6,100. They are saving tax 3,300. Now the basic CGT planning. So now there are some basic tax planning areas for CGT that all individuals should consider. It is split into three areas. First, annual exempt amount. You have to see whether this has been utilized for a tax year or not. Okay. So in order for it to be utilized, you might consider delaying disposal until the next tax year so that you can utilize the next year's annual exempt amount if it has been utilized fully in this tax year. Okay. Or consider bringing forward a disposal if high gains are expected in the next year so that you can utilize the annual exempt amount each year. Next is the rate of tax on your other income. So your level of other income differs between the tax years. Okay. So you have to consider when it is possible to time disposal of assets to the years where your income is lower. If it means gains will be taxable at 10% rather than 20%, try to make sure that your gains are taxable at 10% rather than 20. So you have to time your disposal in such a way where you pay as minimum tax as possible. Now, the third area, timing of disposal. Whether you are bringing forward the disposal or you are delaying it. And also delaying the sale will also delay the CGT payable by a full year. How full year? Because if it falls in the next tax year, remember CGT payable will be a year after that, a year after your tax year. So you can save on your cash flow. In terms of cash flow, it's good. You can delay. For example, an asset sold on 1st April 2024. This will fall in the tax year 23-24. That means CGT will be payable 31st Jan 2025. But if the sale was delayed to 6th April, just 5 days, if you are delaying, it falls in the next tax year and CGT would be 31st Jan 2026. So from 25 to 26. In terms of cash flow, is good. You don't have to pay cash immediately. You can delay by 1 year. Now, so this tax planning points generally no longer work with regards to residential property. If it's a residential property, planning is something else. The 3 points that we have discussed is for your other assets, not residential property. Why? Because residential property, you have to make a payment on account within 60 days. We have just now done a question where the payment on account for residential was on 29 September. Okay, so the last area, that is chargeable gain for companies. Here, the way you calculate chargeable gain is same that you have done for individual. For companies, you calculate in the same way. From sell proceed you deduct your cost, and that's it. Now, some differences are there. These differences will be covered in lecture 18 when we touch companies. So that's it for this lecture. We have covered this lecture. Now the syllabus area that we have touched is section C. because section A and B covered income tax. So we have finished section A and B. Section C, under section C, the first part, your scope and tax of capital gain. We have described the scope of CGT, recognized assets which are exempt. Then we have computed gain and losses. How do you treat the capital losses, the brought forward losses, the current losses. Then about the married couple, the planning, the transfer and all. Then the third area, we have identified chattels and vesting assets that are exempt. Then gain and loss on shares and securities. So identify the exemption available for qualifying corporate bonds and gilt-edged securities. Then computation of CGT. Then use of exemptions. Basic income tax planning. So let us summarize the lecture. So chargeable disposal, when we are selling a chargeable asset and when there's a loss of a non-vesting asset. So it is charged to capital gain tax. Chargeable to capital gain tax for personal taxpayers, but for companies they pay corporation tax. But for companies, their CGT and their income tax. Their gains and their income, they add together, and on that they pay corporation tax. Okay, a chargeable asset is not an asset that is exempt. Let's say any asset mostly. See, other than the list that is exempt, all the other assets that are not there in that list are not exempt. Okay. For example, a private residence is normally exempt because there's a relief for it, which we are going to cover in the next lecture, lecture 13. Then individuals are taxed on the other gains at 10% or 20%. 10% if is a basic rate taxpayer. Remember, to utilize the basic rate ban, we have to take the taxable income. Okay, we have to look at the taxable incomes. They will give you in the exam, they will provide the taxable income, or 20% the balance, higher rate. Then for residential, lower it is 18, higher it is 24%. Companies will be paying one rate, that is the corporation rate, tax rate. Next, incidental cost of selling will be deducted from the sale price. Then any enhancement expenditure will be deducted as well because it will be added to the cost of the asset. Exempt disposal. Exempt disposal will be included in your assets that is transferred at death. See, exempt disposals include assets transferred at death. When you're transferring an asset at your death, that is exempt disposal. That means exempt. They're not taken to CGT, you don't have to pay. But inheritance tax may apply. Inheritance tax will cover later after we finish CGT and corporation tax. Then certain disposal are treated as no gain, no loss, especially when you're transferring between the spouses. And spouses have to live together also. If they're separated, if they're divorced, no gain, no loss will not apply. Then your current period capital losses have to be set off against your current period capital gain before the brought forward losses. Remember that. Okay. First deduct the current period capital loss, then deduct the annual exempt amount. Then deduct the brought forward loss and bring it down to nil. Then if anything is unrelieved, carry it forward to the next year. Then in this area, there are two technical articles. The technical areas are two, but the third one is your skills that you need to develop. This it's like your exam skills. The first one, chargeable gain part 1 and chargeable gain part 2. Please read them in your on your ACCA website. And the next one, this is higher skill that you need to pass the exam. So these are the three technical articles you have to read for this lecture. Thank you for watching, and I shall see you in lecture 13, the continuation of CGT. Do not forget to subscribe if you haven't subscribed to my channel yet, so that you get the notification as soon as I upload the lectures. Thank you.